Right now, Opendoor Technologies Inc. is trading at exactly 7.78 USD, showing a positive intraday movement of 0.040 or 0.52%. Given the current timing, just after the Thanksgiving holiday market closure and entering the abbreviated Black Friday session, this price action represents more than just a quiet holiday drift. It signals a coiled spring in a stock that has become one of the most contentious battlegrounds in the entire Nasdaq composite. While many traders might be distracted by doorbuster deals at retail outlets, the smart money is looking at this ticker and asking a fundamental question about the future of American liquidity. You might expect a company that buys and sells homes to be dormant when interest rates have effectively frozen the housing market. Yet Opendoor is displaying a resilience that defies the basic logic of real estate economics. The expectation here is that high rates crush the iBuyer model. That is the consensus view you will hear on every generic financial news station. But the reality is far more complex and decidedly more interesting. The reality is that Opendoor is no longer just trading on home sales. It is trading on a massive structural pivot that the market is only just beginning to price in, creating a severe dislocation between the stock's perceived value and its potential explosive movement if the Federal Reserve eases policy in the coming months. When you look at a chart like this, hovering just under the $8 mark, you are not looking at a stable asset, you're looking at an option on the housing market's liquidity. Most individual investors, whether they are managing their positions through a Fidelity mobile app or checking their Schwab Intelligent portfolios, tend to view real estate stocks as slow-moving giants. Opendoor disrupts that boredom with volatility that rivals the crypto sector. The 0.52% move today might seem small, but it sits on top of a year where the stock has seen wild swings, driven by a retail frenzy that feels reminiscent of previous meme stock cycles. However, unlike the hollow companies of the past, Opendoor is executing a strategic maneuver that could fundamentally alter its balance sheet. We need to look closely at the refounding narrative that CEO Kaz Nejatian has been pushing. This isn't just corporate speak for reorganization. It is a desperate but potentially brilliant attempt to shift the company from a capital-heavy home flipper to an asset-light software platform. If you are holding Tesla stock or Nvidia stock, you are used to valuing companies based on their tech stack and future growth multiples. Opendoor investors are now being asked to do the same, to ignore the houses on the balance sheet and value the algorithm that prices them. This is a high-wire act. If they succeed, they become the Amazon of real estate. If they fail, the debt load could be catastrophic. This tension is what keeps the stock hovering at these levels, with bulls and bears locked in a stalemate that could break violently in either direction. Let's examine the mechanics of what is happening today. The trading volume is relatively suppressed due to the holiday, but the bid-ask spread is telling. It is tight, suggesting that despite the holiday, algorithmic traders and institutional bots are active, defending this 7.78 level. This price point is psychologically significant because it represents a consolidation zone after the massive volatility observed earlier in 2025. When you use Interactive Brokers trading platforms or look at the Level 2 data on your Robinhood app, you will likely see walls of sell orders sitting just above $8. Breaking that resistance is the key technical challenge for the bulls. But why would it break? The answer lies in the macro data we have seen recently. The Federal Reserve has signaled that while the battle against inflation is mostly won, the last mile is sticky. This has kept mortgage rates elevated, which theoretically hurts Opendoor. However, the market is forward-looking. Traders are buying Opendoor stock today, not for the houses they sold last quarter, but for the houses they might sell in 2026 when rates are projected to be lower. It's a duration play. You're essentially betting that the company has enough cash runway, which recent reports suggest is around $962 million in unrestricted cash, to survive the winter of high rates and emerge as the dominant player when the spring thaw arrives. This brings us to a critical distinction that many casual observers miss. There is a profound difference between the old Opendoor and the new Opendoor. The old model was simple: arbitrage, buy a house, fix it, sell it. That model killed Zillow's iBuying business and forced Redfin to retreat. But Opendoor persisted. Why? Because they believe their data advantage is superior. They are betting that their proprietary pricing algorithms can identify mispriced assets better than a local real estate agent can. This is where the AI narrative comes into play. If Opendoor can automate the pricing and inspection process to a degree that reduces their overhead significantly, they can make money even on thin margins. This is the thesis that keeps institutional investors like Vanguard and BlackRock interested, even as they trim positions elsewhere. And it is why we see such heated debate on investing sites and forums. The skepticism is warranted. They are still losing money. But the potential upside of digitizing a multi-trillion-dollar asset class is so large that the market refuses to let the stock die. Consider the retail investor's perspective. If you are engaging in self-investing or looking for investment help, you are constantly told to diversify. A Schwab Intelligent Portfolio might allocate you to broad real estate ETFs, but picking a specific winner in the prop tech space requires a stomach for risk. Opendoor represents the ultimate high-risk, high-reward play in this sector. It is not a safe dividend payer. It is a technology company masked as a real estate firm. The recent move to issue warrants to existing shareholders was a masterclass in financial engineering designed to punish short sellers. By giving shareholders the right to buy more stock at a set price, management effectively created a poison pill for anyone betting against them. This caused a short squeeze that sent the stock flying earlier this year, and the aftershocks of that event are still keeping the price buoyant at 7.78. This is the kind of tactical warfare you rarely see in boring blue-chip stocks, and it signals that management is willing to fight dirty to protect the stock price. Let's look deeper at the business model changes. The shift towards exclusives, their marketplace where they connect buyers and sellers directly without taking the home onto their own balance sheet, is the most important development to watch. If they can scale this, they become a platform like eBay rather than a store like Walmart. Platforms command much higher valuations because they have higher margins and lower risk. This transition is slow, however. The bulk of their revenue still comes from selling inventory they own, and that inventory is subject to market risk. If home prices crash, Opendoor loses money on every house they hold. This is the inventory risk that bears cite constantly. But here's the counterargument. Inventory levels are historically low. There is a shortage of homes for sale in America. This scarcity puts a floor under home prices, which ironically protects Opendoor's downside. Even if demand softens, prices are unlikely to collapse because there simply isn't enough supply. This supply-demand imbalance is the safety net that allows Opendoor to operate with such high leverage. Speaking of leverage, let's talk about debt. Opendoor uses non-recourse debt to finance their home purchases. This is a crucial detail. Non-recourse means that if they default on the debt for a specific batch of homes, the lender can take the homes, but they cannot come after the company's other assets. This structures their risk in a way that is often misunderstood. It isolates the risk to specific inventory pools. While the headline debt numbers look scary, the actual corporate risk is managed. This is the kind of nuance that you need to understand if you are going to trade this stock on a Fidelity trading platform or through Interactive Brokers. It is not just about the top-line number, it is about the structure of the liabilities. Now I want you to take a moment and think about your own view on the housing market. Comment below how many shares of Opendoor you currently hold, or if you think the iBuying model is destined to fail regardless of interest rates. The psychological aspect of this stock cannot be overstated. It is a battleground between the believers in a digital future and the staunch defenders of the traditional real estate agent model. Every time you see a for sale sign in a yard, you are looking at the inefficiency Opendoor is trying to solve. The friction of showing a home, the uncertainty of closing dates, the emotional toll. Opendoor sells certainty. In a world where convenience is king, there is a strong argument that the consumer will eventually force the market toward the iBuyer model, just as they forced retail toward e-commerce. Recent sector momentum has been mixed. While SoFi stocks and fintechs have rallied on hopes of lower rates, real estate tech has lagged. This lag is the opportunity. If the correlation between fintech and proptech reestablishes itself, Opendoor has a lot of catching up to do. The stock is currently trading at a fraction of its past highs, which implies that a lot of bad news is already priced in. When a stock stops going down on bad news, that is often a sign of a bottom. We have seen lackluster earnings, we have seen guidance cuts, and yet the stock remains stubborn at 7.78. This relative strength is a technical indicator that accumulated